Welcome back to the deep dive. Today, we're diving into a pretty ambitious question that you hear a lot in financial circles. Could silver, the historical money, the industrial workhorse, could it actually replicate the kind of massive price re-rating we've seen in assets like Bitcoin?
It's a really compelling thesis, and our mission today is, I think, very straightforward. We're just setting all the hype aside. We're going to strictly look at the structural data, the supply constraints, demand trends, market history, everything that might make a major silver pop plausible.
Or what might prevent it entirely?
Exactly. We have to be rigorously evidence-based on this one.
Absolutely. The goal here isn't to give you a price target. It's to understand the fundamental mechanics. We want to walk away understanding the argument for why silver might be, a tightly coiled spring. But also, we need to be realistic about the major headwinds and the constraints that separate it from, say, gold or cryptocurrencies.
Exactly. We're distilling the key insights on silver's valuation, its very unique supply and demand profile, and how its physical scarcity interacts with the vast financial market built on top of it.
Okay, so before we even get to demand, we have to tackle the biggest myth, the thing that always comes up in this discussion. You always hear there's this massive amount of silver just sitting there, mined throughout all of history. If that's true, how can anyone possibly argue for scarcity?
That's the crucial starting point, and it's a classic case where the big headline number is, well, it's functionally misleading. When you see the latest public estimates of global above-ground silver stock, it sounds immense.
Right, it's everything ever pulled from the earth.
Everything, but you have to immediately break that total down into two very different non-fungible categories.
Let's define those two buckets.
Okay, first, you have the truly investable supply. This is the pool of liquid silver. We're talking bullion bars, coins, the metal and official vaults that's actually available for investment.
The stuff you can actually stack.
The stuff you can stack. And that pool it's relatively small. The second, and by far the largest category, is the fabricated silver, industrial jewelry, that kind of thing.
So you're talking about the tiny bits of silver soldered into every single phone, every laptop, the conductive paste in solar panels, maybe the silver in my grandmother's cutlery set.
Precisely. And here's the critical insight. That enormous total stock number is misleading because all that fabricated metal is largely illiquid. It's either dispersed in billions of microchips or it's simply not economical to recycle.
Not until the price goes way, way up.
Multiples of where it is today. The sources suggest that only a small fraction, maybe somewhere between 5 and 15% of that total above-ground stock, is realistically investable and stackable.
Wow. That completely reframes the scarcity argument, doesn't it? The true measure is liquidity. So if maybe 90% of all the silver ever mined is functionally trapped in old products, then the available pool for investors is just it's orders of magnitude smaller.
That's it. Exactly. It clarifies why this abundant historical stock does not mean there's abundant bullion available for investors or for industrial users when they need a quick delivery.
Okay, so that's the available supply. A much smaller pool than most people think. Now let's talk about flow. Is that pool actually shrinking? Is the world running a silver deficit?
Yes, the data confirms it. And it's been a persistent structural deficit in recent years. When you look at the recent data for supply and demand, total demand has been exceeding total supply. And by supply, I mean global mine production plus all the recycling volumes combined.
So what's driving that gap? I mean, mining output seems pretty steady, and we just established that recycling is difficult. So it has to be demand, right?
It is entirely demand, specifically industrial fabrication. And this is really where silver is unique compared to gold. Gold is mostly a store of value.
Right.
For silver, industrial demand is the engine. And it's tied to these massive global trends. Think clean energy, advanced electronics, electric vehicles, all incredibly silver intensive.
Can you give us a sense of scale on that? I mean, what kind of volumes are we talking about in just those high growth sectors?
The sources really emphasize solar energy, photovoltaics, or PV. Solar panels need silver paste for conductivity. And while the exact amount per panel is shrinking, the number of panels being made is exploding. Projections show global solar capacity growing by maybe 25% or more annually.
That creates a sustained compounding demand floor for silver that mine supply just can't keep pace with.
It can't. A huge fraction of annual mine output is now consumed just by the solar industry.
So as this green energy transition accelerates across the globe, silver demand is structurally locked in to increase, which means industrial users are constantly drawing down what's left of that investable bullion inventory.
That is the key takeaway. The structural deficit means every single year, to meet fabrication needs, we have to dip into those limited vault holdings, those existing bullion stacks. It's fundamentally bullish for the physical market, but it makes the next question even more pressing.
Okay, let's unpack this apparent contradiction. If investable supply is shrinking and industrial demand is booming, why isn't the price already much, much higher? This gets us to relative valuation. Let's compare silver's market size to, well, to other stores of value.
This is where the scale of the potential undervaluation really becomes clear. If we estimate the notional market value of all the existing investable silver, that small pool of bullion, bars, and volt holdings, using the current spot price, the total value is, frankly, surprisingly small.
Smaller than gold, its historical peer.
Oh, the difference is dramatic. The global value of all above-ground gold is multiples larger, maybe 100 times larger than the liquid silver pool. Gold's market value is in the tens of trillions of dollars.
And silver.
Investable silver is in the low hundreds of billions.
That is an astonishing difference. But is it a fair comparison? I mean, gold is pure money. Silver is mainly an industrial input.
A valid challenge. But silver was also money, and it still has that identity for a lot of investors. The real shock, I think, comes when you compare it to a modern asset, like Bitcoin. When we compare the market value of all investable physical silver to the market cap of Bitcoin, an asset with zero industrial use, the physical silver market is often substantially smaller.
Sometimes by a factor of 2 or 3.
Exactly.
So what that implies is that a really small shift of capital, say 5% of what's in gold, or even a fraction of Bitcoin's market cap, if that money was diverted only into physical silver, it would have an outsized, a potentially explosive impact on the price.
That's the math. These comparisons highlight silver's dual nature. It's an essential industrial commodity and a historical hard asset, yet its liquid market value is just incredibly constrained relative to its peers. It suggests a significant undervaluation.
Okay, so this imbalance, this tension between physical scarcity and a low price, brings us to the core issue we have to explore. Structural distortions. This is where it gets really complicated. Why does the paper market seem to dominate price and not physical scarcity?
This gets into the vast system of futures and derivatives, what people often call paper silver. The sources here provide extensive documentation of, well, structural problems. Specifically, documented, credible cases of market manipulation in the precious metals futures markets.
And crucially, these aren't just vague theories. These are proven regulatory events, right?
Absolutely documented. The sources point to numerous enforcement actions, fines, even convictions against major financial institutions. These come from bodies like the Department of Justice, the CFTC. The charges often relate to spoofing.
Can you explain spoofing just quickly?
It's an illegal practice where traders place huge, visible orders they have no intention of executing. They want to trick other market participants into trading at a certain price, and then they cancel their own orders milliseconds before they get filled.
So if I'm a big bank, I can flash a massive sell order, which spooks the market and makes the price drop. Then all the smaller traders panic and sell, and I just pull my fake order and scoop up what I really wanted to buy, but now at a cheaper price.
That is the mechanism, yes. Now scale that up. The futures market creates a massive volume of paper claims on silver that can be traded hundreds of times over. And that paper volume just dwarfs the available physical supply. When spoofing or targeted shorting happens in that market, it completely distorts what we call price discovery.
So in effect, the price you see on your screen, the spot price, is being dictated by these fake orders in a digital marketplace, not by the genuine supply and demand of physical metal being consumed by solar panel factories around the world.
That's a perfect way to put it. The paper market can systematically suppress the visible cash price, pulling it away from the tightening physical fundamentals we've been talking about.
Okay, that lays the groundwork. So given the deficit, the undervaluation, and these market distortions, what scenarios could actually trigger a pop? That moment where the price decouples from paper and re-rates based on physical reality.
We've identified 4 plausible, realistic triggers. The first is a straight industrial demand explosion. We talked about solar, but think about EVs, 5G, all advanced electronics. If that demand continues its exponential growth, it could permanently outpace what mines and recyclers can provide. The deficit becomes chronic and acute.
The physical squeeze just gets tighter and tighter. What about the investor side?
That's the second trigger, investor stacking. This would be large-scale, coordinated buying of physical metal. Bars, coins, vault holdings. If serious capital starts flowing into physical holdings, it just locks away that already limited investable supply. You'd see available inventory in the vaults just plummet.
The third scenario feels like it's more about the wider world and the macro environment.
Yes, macro triggers. Think high inflation, major currency devaluation, geopolitical instability, a flight to safety. If confidence in fiat currency really starts to erode, demand for all hard assets skyrockets. And because the silver market is so small compared to gold, even a tiny fraction of that capital seeking a safe haven would have a huge price impact.
And the final one is a shock to the source itself.
A supply-side shock. Even if the price of silver rises, it's not a guarantee that mining can respond quickly. We're seeing constraints like declining ore grades. It costs more to get less silver, fewer new discoveries. Plus, about 2/3 of silver is a byproduct of mining for other metals, like copper or zinc. So a slowdown in those industries automatically limits fresh silver supply, no matter what the silver price is.
So we have this powerful bullish case, scarcity, demand, value, but we have to stay balanced. What are the headwinds? What keeps silver from just taking off tomorrow?
The constraints are very real. First, let's go back to that immobile stock. As we said, maybe 90% of all silver is trapped in fabricated forms. Until the price gets high enough to make reclaiming it from old circuit boards and industrial scrap actually profitable, that supply is effectively off the market.
So higher prices will eventually incentivize more recycling, which acts as a sort of ceiling. Okay, what's next?
Substitution and technology. As the price rises, industries have a huge incentive to innovate. They will try to find technological substitutes for silver, or just become far more efficient in how they use it. So high prices could, over time, actually reduce the rate of demand growth.
And we can't ignore its reputation, can we?
Its volatility. Silver has a history of sharp, dramatic price swings. It overshoots, both up and down. Even with strong fundamentals, that volatility might make institutions hesitant to see it as a stable store of value compared to, say, gold.
Okay, let's talk about the market structure itself. If everyone listening decided to go out and buy physical silver tomorrow, what actually happens?
That brings us to the logistical constraints.
Right.
The paper market is designed to be frictionless. The physical market is. Well, it's not. If everyone holding a paper claim suddenly tried to convert it into physical bullion at the same time, the market just doesn't have the capacity.
What does that look like? The mints run out of coins.
It looks like soaring premiums, where you pay way more than the spot price for a physical bar. It looks like delivery delays stretching for months. There are limits on how fast refiners can pour bars, how fast you can securely move and store tons of metal. This friction slows down any potential stacking mania, and it can give the paper market time to recover.
And finally, we have to admit, all of this analysis rests on public data, which is never perfect.
Correct. Data uncertainty is a final risk.
Yeah.
These are expert estimates and models, not perfect audits of every ounce of silver on Earth. So there's always a degree of uncertainty built into the thesis.
This has been a really fascinating look at both sides of the coin. We've got a strong structural case, a chronic supply deficit, a huge undervaluation, and documented market distortions.
But we've also got that formidable resistance, the huge immobile stock, the threat of substitution, and the logistical bottlenecks. Silver presents a really serious long-term opportunity, I think, because of its unique mix of being an industrial necessity and its profound undervaluation. But there are very realistic obstacles.
So for you, the listener, what should you monitor going forward? If you want to track this story, what's the checklist?
You should focus on data points that measure physical movement, not just the daily spot price. First, watch the annual supply and demand reports. Focus specifically on that structural deficit number. Is the world using 50 million ounces more than it produces, or is it 100 million? Is that gap growing?
And on the investment side of things,
Track the vault and ETF physical holdings. If those reserves start dropping sharply, especially from ETFs that are backed by physical metal, that tells you the investor stacking scenario is playing out. Next, watch the industrial demand growth rates, especially from solar and EVs. If those numbers keep accelerating, the squeeze gets tighter no matter what.
and finally, mining and the macro picture.
Right. Keep an eye on mine production trends. Are new mines coming online or is output falling? And critically, monitor the key macroeconomic indicators. Inflation, central bank policy, currency strength. Those are the factors that will determine if the world sees silver as just an industrial metal, or if it rediscovers its role as a necessary monetary hedge. And that is the difference between a strong price move and a true Bitcoin-style re-rating.
The potential for silver to achieve that kind of re-rating really depends on those bullish scenarios, overcoming some very powerful structural constraints. Thank you for guiding us through this deep dive.